We all have our own investing strategy and we care about different key metrics, but there are some universal pros and cons that we need to be aware of. I've noticed that there's a polarizing difference between investors when it comes to high-yielding assets. And I touch on some of the more obvious pros and cons of high-yield ETFs in some of my videos. But in this video, we'll dive deeper to clear up some of the misconceptions on both sides of the fence regarding the high-yield debate. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please massacre that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to your mind as you watch the video. And if you really like what you see in these videos, consider becoming a channel member. Information in the description below. And you know what time it is. Let's grow. The compound problem. High-yielding ETFs, like my favorite, JEPQ, provide that juicy cash flow from the moment we buy them. It's hard to imagine that a lower yielding ETF could make any sense, short or long term, when we could triple the yield now. We humans are not wired for delayed gratification. It takes serious determination to make the best long-term decisions in the moment. I'm gonna show you a question that I was recently asked on this channel, and this member is not alone, by the way. This is the most common question I have received since starting this channel over a year ago. The comment starts out with, "Great video, Jeff." I think that's why I really showed this one. One question: wouldn't it make sense to hold JEPE or JEPQ until SCHD catches up to the 10% yield that they offer? I don't see why one would hold SCHD until it passes JEPE and JEPQ in yield. What am I missing? And the answer is compound interest. It's hard to grasp the true power of dividend growth even if you look at this stuff all the time. But we're going to try. I'll be referring to JEPQ in this video. It's my favorite covered call ETF, but there's a lot of great ones out there. You guys throw them in the comments all the time. Under 10% of the dividends paid by JEPQ are qualified dividends from the underlying holdings. But over 90% of JEPQ's income is from the derivatives, the covered calls, and it'll be taxed as ordinary income, and the amount will be random based on the market's volatility. We should never assume implied dividend growth over future years on covered call ETFs that use derivatives to produce income. It's kind of like the same logic of not assuming that a high yield savings account or a money market will grow its dividends. When the federal fund rate, in that case, goes up, it goes up. When that Fed fund rate goes down, they go down. Let me show you what this looks like over time compared to the quality dividend growth ETFs. I pulled up JEPE out in Seeking Alpha, and I do have a Seeking Alpha affiliate link if you or a friend wants to try premium for free for 7 days. I love it, use it all the time. And if you like what you see, you can save some money on your first year. Where I want to direct our attention is on the dividends tab here, and we're on the dividend scorecard. Now you can see right here that the dividend yield for the trailing 12 months is a pretty juicy 7.22%. And I did pull JEPE because it has more history than JEPQ, but JEPQ is also negative on its short history. It only has the trailing 12. But the trailing 12-month dividend growth rate is negative 22%. And the 3-year dividend CAGR is negative 3%. And looking at the dividend history graph, we could see that it started back here on 6/30/2020. I'm on the last 5 years, but it was new as of 2020. But the dividends were pretty juicy, and then they went way down. And then the per share dividends were juicy when the volatility was high, and then things smoothed out and they went way down. So that's what I mean by random. It truly is random. You cannot assume dividend growth with something like JEPE. As a counterpoint, I've pulled up SCHD now, and you can see that it has a less juicy yield of 3.38% on the trailing 12 months, but the trailing 12-month growth rate is nearly 9%. The 3-year compound annual growth rate of the dividend is 9%. The 5-year is 12.88%, that's juicy. And the last 10 years, it averages increasing by 11%. Now remember, with our rule of 72 and my short form of it, if you average going up 10% per year, you double every 7 years. This is true for your portfolio value and for dividends. So what's that look like? Let's go to its dividend history. And since SCHD has more dividend growth history, we can group these up by years instead of the months. But you can see you started at $1.05 per share 10 years ago. And that was in 2014, and every year it just gets more. Remember, JEPE and JEPQ are all over the map, but this growth just keeps going up. And all of a sudden you zoom out in 2023 here, you have $2.66 a share compared to what you started with $1 per share. You've almost tripled. That's the power of dividend growth. It's only 10 years, and now your yield on cost is doubling every 7 years on average with SCHD. So instead of a 3.5% yield, you would effectively have, like around here, you would effectively have around a 7% yield. And then 7 more years, you'd have about a 14% yield on the stuff you bought back here. That's the power of compound. And we'll get more into this topic. Now let's use a relatable example that takes zero investing experience to follow. Okay, we're out here in Excel where I made my example, and I hope you guys can see this okay. I zoomed in a lot, so I hope it's not too blurry. So congratulations on landing your new job. You have 2 payment options. With option 1, you get a juicy 6-figure $100,000 per year as your starting salary. We can only afford to let it grow by 2% per year to somewhat keep up with inflation. Or you could take option 2, you start with a measly $50,000 a year, but we'll increase it by just 10% per year. What do you take? And now I'm sure you understand the point. I'm sure you know what's coming. But in the comments, do not lie to me. Let me know if you knew just how crazy this gets. And this is exactly how dividend growth works. Let's drop this Excel sheet to the floor and make it shake. After 1 year, you have $100,000 or $50,000. I think 1 versus 2. So this is always going to be option 1 minus option 2. Well, the 100,000 person won by 50K. What a sucker this guy is. Wait a minute. The gap is narrowing and you got a nice juicy raise. You know, only 2,000 there and 5,000 here. That's not going to move the needle, right? But then you come down these years, 5 years into it, you're at 108 and 73. You know, getting a little tighter, but nothing crazy. Let's go to year 10, 119 and 117. And this person made up ground. You know, this person hopefully didn't lifestyle up too much as they were making more and more money. And I'm sure this person had their fancy cars early, but all of a sudden we're basically tied up after 10 years. So let's just keep scrolling down here. After year 15, you're at 190,000 versus 132. That's kind of crazy. That's year 15. After year 20, we're at 305,000 to 145. Now we have 160,000 per year lead. 25 years into our career, wow, we're almost at $500,000 and they're still at 160. These high yielders, I tell you. 30 years in, okay, we're gonna stiff $1 million someday. Yes, we did. We make $1 million a year instead of 188. And let's just rip off the Band-Aid. 40 years in, over $2 million per year instead of 216,000. Now, of course, this is not realistic for a work situation. We all understand that, and there's limitations, and you know how it goes in corporate. But this is exactly how investing works, and it's scary. So if you thought you'd be almost 2 million ahead, then you're really smart, and you're also a liar. Your brain is probably saying BS, and this seems unreasonable. But believe it or not, dividend yield and dividend growth have the exact same logic baked into them as that example that I just showed. And you may have found yourself screaming at the salary example because it didn't reinvest the dividend surplus in the early stages. And you're right to a certain extent, but the high yielding assets will generally fall short of the index they're trying to mirror on total returns over time, and that's just because they trade long-term growth when they cap themselves for that guaranteed income. When the market goes up over per long time, they lose. When the market goes down, they win. And generally speaking, as you know, over long periods of time, the market goes up. I'll provide a few examples now that'll help drive this point home. So I'm starting out here in Seeking Alpha with JEPI pulled up, JEPI, the JP Morgan Premium Income ETF that follows and seeks to track the performance overall on total return of the S&P 500. And you can read about that from the ETF itself. And as you can see here, JEPI is up 68.6% to the market, VU's, almost 100%. And this is total return dividends reinvested. It gets crazy when you don't have dividends reinvested. But you can look at the bars here. The market goes up more and it goes down more. And then it goes, they both pretty flat, up more, down more, up more, down more, up more, down more. So it's hard to explain it in perfect technical terms, but this is impossible for it to not work this way, because when you have an investment that the underlying holdings are a lot of the conservative companies from VU and and you're writing calls on these, you're basically limiting your ceiling with JEPE. So if it goes to the moon, you get your guaranteed premium income, but you give up a lot of those gains, but you're increasing your floor with guaranteed income. So you can see when this right here, the blue bar crashes more because the market went down. So they both went down, the underlying holdings, but that premium income went directly into our pockets and the other party didn't get a strike or execute the option. So basically we didn't give up any shares and we got to keep the premium income. But when you zoom out over long periods of time, and this is universal, you can check a whole bunch, VU will outperform JEPE unless everything doesn't go up in the next 10, 15, 20 years. And I forgot to mention on JEPE, I pulled as much data as possible. So it was from inception and it had a little more data. This is JEPQ, as you can see here, and it's newer. So I have from 5/4/2022 when it started getting data. So we have 853 days of data. JEPE had more than that. Its direct index is the NASDAQ 100 or QQQM, if you want to do a low cost way to invest directly in it, keep the qualified dividends and the yield lower and grow more. JEPQ seeks to track the performance of the underlying index of QQQM. These will have a ton of overlap, but this one does that covered call thing that I was just talking about. And as you can see, in a market that overall has gone up, QQQM is up 42.5% to JEPQ's almost 33%. And again, on the markings, look at the orange bar, how consistent it is. That's that premium income, loving the volatility and not worrying about what's going on with the markets. You're always collecting that income, but you can see the ups aren't quite as high. The downs are a little more similar, but they are less extreme. The ups are definitely less extreme. This is that ceiling cap I was talking about. It's similar logic to JEPE versus QQQM. In an up market, QQQM will mathematically always win over long periods of time. It's nearly impossible for that not to be the case. In a down market, JEPQ and JEPE should, in most cases, perform better than their underlying index. Over the last 100 years, the market goes up about 10%. This is not a good long-term growth position to be in compared to this. And same with JEPE versus VU and any of these derivative things versus any of their indices over long periods of time, but they're great for cash flow now. The asset with the highest total return ultimately compounds the most wealth on the net math. And there are some tax implications that can come into play, but those actually, generally speaking, go against the high yielding asset when comparing that portion of the return compared to the long-term capital gains or qualified dividend portion of the return from the competition. So we just won't go into too much detail there, but know that taxes do matter and they actually go even more against high yielding assets, generally speaking. They cause a forced taxable event in the moment they happen instead of accumulating tax-free until you sell them later on at the favorable long-term capital gains. We're going to take a look at an example I used in a recent video, but this time we're going to include that reinvestment piece. Here's the spreadsheet of Retire on SCHD, and recently I made an example of a guaranteed 5% high yield savings account versus the SCHD, and it's using real data, zero assumptions in this. Now, of course, as many of you know, a 5% guaranteed cash account did not exist during these years. I was just doing the what if to show, if it existed, how it would work, okay? And I'll try to be quick here because I know I'm probably dragging this one out like all my videos. What we have is this was the initial dividends received from SCHD throughout the experiment, and they added up to 316,000. And the high yield savings account had 5% solid, no growth, right? So of course, same amount each time, and it added up to 275. So I was saying, 316 is bigger than this. But then one of you out there, even though I called this out in the video, but someone had to say, yeah, but the high yield savings account would be way better in reality because you get an excess. And I said, yes, that's true, but technically adjusting for that will help SCHD long-term. And they commented back like, I drank my bathwater again. So I went ahead and modeled this out. And we'll try to be efficient here, but in the first year, it's 2013. This up here is just for information for growth and things like that. So we received $16,000 of SCHD dividends in the first year versus $25,000 of the HSA. So to make up this $9,000 gap, we had to sell 247 shares of SCHD. And that was reflected at the year-end price of $36.66, year-end price of 2013. We had to sell to get that money that the savings account gave us. And so now we had 247 fewer shares in 2014. So that's reflected there. This is just my math checker down here. I had all the formulas up here, but I wanted to prove that I wasn't making things up. So as you go down on the years, you're having to make up for the low yield of SCHD. And remember, the high yield savings account, you have 500,000 in it. I should have started there, and it creates 25,000 a year. So at the end, you've had this many dividends and your value is 500,000. With the SCHD, you put 500,000 in at the same date at the initial price right here at the end of 2012. So 13 was the first year, and that bought you this many shares. I should have started with that. So as you go, you have to make up. But remember, reinvestments versus compound isn't your main factor. It's technically total return. And when you hit a certain threshold, HD with the dividend growth, which has helped total return, is actually producing more dividends a year. So now we have to buy these more shares of SCHD to get rid of the excess money. So 29,000 is 4,200 too much compared to the competition. So we purchased new shares of SCHD. So when you run that logic all the way through both ways, all of a sudden you're buying a lot of new shares, and only 11 years in, you already have more shares than you started with, but it only gets more drastic. That's what I was trying to tell that person. You're actually arguing against yourself. SCHD is going to run away more. Now, at the value of SCHD is up here at 1.36 million. And in the original scenario, it was actually only 1.34 million. And remember, it had just broken even with this crazy growth. This is going to get wildly higher. This will be 2 million, 3 million, 4 million before you know it. And this will forever be 500,000 to produce that income. And now realistically, inflation is going to eat this away, like I mentioned in the first video, and this one's forever okay. Because if inflation gets to this number per year, we're all doomed. So I just wanted to mention, bad argument to say, oh yeah, but you could reinvest the difference. So that's a common one I hear. That's a misconception. You have to look at total return, not dividends or just share price. It's the whole package. Now that we've covered all the reasons that high yield ETFs are terrible, let me tell you why I love them. Where high yield shines. High yield ETFs are great for people in or close to retirement. The amazing compound power of dividend growth is great and all, but that doesn't help us pay the bills now. For example, if you need $50,000 per year in retirement to get by, and you have a portfolio, let's say when you sum everything together at the end of your career of $750,000, HD and DGRO, two of my favorite dividend growers, aren't gonna cut it. Let me show you what I mean. Okay, I opened up my Google Sheet with this retirement calculator, and these are out there for free for anyone watching this video. You can see the comments below for access to my Excel spreadsheets or my Google Sheets. I'm an Excel guy, but I decided to mix it up and use Google Sheets for this one. But this format can be found out there if you want to throw in your own numbers. And I should mention there are tutorial videos in the OneDrive folder, so please watch those if you're confused on using them. Or there's a written guide for some of the Google Sheets on the Google Drive. So we have $750,000, and I went ahead and plugged in $350,000 for DGRO and $400,000 for SCHD. So what this does, and these are real growth rates, so this is the 10-year CAGR for SCHD, and you can put in lower, more conservative ones if you want for anything. I actually gave JEPQ a 1%, which it should be 0 in my opinion. And DGRO is 9.3. It's not quite 10 years old. Actually it is, but it doesn't reflect a 10-year CAGR yet, but this is basically it. So here's the rub. If you look at your dividends per year here, and this is your purchasing power for a year. So it takes our assumed 3% inflation, which you can change here. I assume 3%, and it takes this dividend growth rate. So it just runs these numbers out. This is your dividends per year, and this is your dividends per month. This is what it's worth to 2024 dollars all the way down. So your purchasing power, are you beating inflation? And same thing per month. So just staying in the year column, our purchasing power is going to the moon. You know, we're crushing inflation and way into retirement, we'll have 6 figures. That's great. Oh wait, we only produced $21,000 in 2024. That is not enough. That's sort of the point here. So let's put $750,000 in JEPQ and 0 in the others. Now we have a measly 1%, and you can see your purchasing power starts to lose to inflation. Your future value on your money is going down. So in 2041, it's as if you have $50,000 in 2024 dollars instead of 71. So you've actually lost purchasing power. It's gone up to 84, but that's only worth this much. That's what that inflation here eats away at purchasing power. So yay, now we're crushing that 50K mark, but we're not future proof. So it's like, oh, okay. What if we do 400,000? And I'm just making these up. We'll see if I can make this work roughly. 300,000 and what, 50,000? So now we're almost at 50K. That was a pretty good guess. I truly don't pre-plan these. Let's do 275 here and 425 here. See, now we're hitting our 50,000 mark in year 1. So right here in 2024, we're good. And we're beating inflation because the weighted dividend CAGR is 5.22%, and the yield, the weighted yield, is nearly 7%. So this is a nice combo. I might even, go as you go get your purchasing power up over the years, you can slowly trickle some JEPQ into these guys. But the point is, there's no right way to do it. You need to produce money now to live, but you also need to beat inflation in the future. So build a balanced portfolio and win. The best solution is to calculate how much money you'll need in retirement and then add 25% to it. And I say 25%, that's not set in stone. You could use 20, you could use 50%. But this is to account for taxes and unforeseen expenses. And a lot of times things look great on paper, but in reality, we need a little more. There's that thing called inflation. Once you've calculated the number that you are comfortable with that you'll need for yearly expenses and everything in retirement, take that number and work backwards. Build a portfolio with the lowest yield possible to still hit your mark. And while you're probably wondering what's wrong with me, and again, I will never have enough time to cover that with you, in this particular case, I say you want the lowest yield possible. You always hear you want to go high yield in retirement, but you want the lowest yield possible to get by because over time, those assets will generally outpace inflation. You want the lower yielding growers if possible, but of course you'll probably have to mix in some of those high yielders to get by in the early years. For example, if you have millions and millions of dollars, 10 million or more, just invest in something like VU or VTI and use those dividends to live the good life. If your portfolio value is a little bit low, because say you got started late or something like that, you'll need the JEPQs of the world or your favorite high yielding assets to get by, especially in the early years. Most of us will fall somewhere in the middle, and you just want that balanced portfolio that makes sense to you. Best for younger people. We all have different goals and risk tolerances, so there isn't one right way to go about investing for everyone. And while I don't like to make comments like this because to each their own, I will say that high yield investments are objectively bad for younger people with a lot of years left to invest. It won't compound as well over multiple decades, assuming that you have a stable career, your dollar cost averaging into the market during that whole time horizon, and you never panic sell when the market drops. And I don't think you should take my word as the law or a fact. You should always be skeptical of anything you read or hear, including stuff from me, but I would highly encourage you to do your own research, look into the deep history of high yielding assets and their compound returns over multiple decades compared to the general market, say VTI or VU. And even though you hear those stats about dividend stocks outperforming non-dividend stocks over the last 100 years, dive a little deeper specifically about the high yielding assets. And if you don't want to put in the research, and that's completely fine, and you want to take this guy's word for it, I would highly recommend just piling money into VU or VTI over many decades and just don't sell, be a robot, dollar cost average in on autopilot, and you'll do very well. Nobody ever in investing history has lost to inflation even by dollar cost averaging into the S&P over the last 100 years. Not one single outlier. Stick to your system in all markets and win this simple game long term. And speaking of winning, we had 4 new channel members this week. A huge shout out to the 4 of you on the screen now, and of course to everyone that's been here all along. I really appreciate the extra level of support. It means a lot. Enjoy those emojis, badges, comment priority, and my market moves real time as I make them every Monday morning with my members only post. And check out one of these 2 videos if you're somehow not bored of this stuff yet and you want to keep learning. I think it will be well worth your time. Thanks for watching, and I will see you here next Sunday. Peace.